A teacher and a dentist both set aside $40,000 a year for 10 years. The teacher puts hers in a savings account and her 401k, exactly like she was told. The dentist puts his into a whole life insurance policy, the one product almost every money guru on the internet screams at you to never buy. 10 years later, they each need $100,000 in cash. The teacher withdraws hers. She pays tax on the gains, and the moment that money leaves her account, it stops growing. The dentist borrows $100,000 against his policy. He pays zero tax on it because a loan is not income. And here's the part nobody explains to you. His $100,000 keeps compounding inside the policy as if he never touched a dime of it. That is not a trick. That is how the contract is built. The wealthy have a name for it. They call it being your own bank. Aunt Yvonne watched a business owner run this exact playbook for 20 years. She told me on her porch last month that the rich do not store cash the way the rest of us do. They store it inside a policy, borrow against it for cars and rentals and their kids' tuition, and let the same dollars work in two places at once. Standard advice says whole life is a scam. For most people buying it the wrong way, it is. But used the way the wealthy use it, it becomes a tax-free private bank you control for life. Today, I'm going to show you exactly how the machine works, the math on a real policy, who this is actually for, and the 3 ways people get burned. Before I show you the machine, 3 honest frames. Because this is the most oversold product in personal finance, and I am not here to sell you anything. 1. This is educational, not advice. Whole life insurance is a decades-long contract with real costs. The structure that makes the wealthy strategy work is very different from the policy a commissioned agent will try to sell you. Do not buy anything off a YouTube video. If you pursue this, work with an advisor who will design the policy for maximum cash value and the minimum commission, and ask them to show you the numbers in writing. 2. This is wrong for most people. If you have credit card debt, no emergency fund, or you have not maxed your 401k match and your Roth, a whole life policy is not your move. The gurus who say buy term and invest the difference are right for the average household. This strategy sits on top of a finished financial foundation, not in place of one. 3. The growth is modest. The advantage is structural. The cash value inside a good policy compounds at maybe 4 to 5% over the long run. That will not beat the stock market. What it gives you instead is tax-free access, guarantees, and the ability to borrow without ever interrupting the compounding. That combination is the whole point. With those frames set, here is what whole life actually is. Most people only know term insurance. Term is simple. You pay a small premium, and if you die during the term, your family gets a payout. If you outlive it, you get nothing back. It is pure protection, and for covering your income during your working years, it is the right tool for almost everyone. Whole life is a different animal. It is permanent insurance, meaning it covers you for your entire life as long as you pay the premium. It never expires. And it has a second component bolted onto the death benefit, a cash value account that grows every single year. Here is how the contract is built. You pay a premium, much higher than term, because part of it buys the insurance and part of it goes into the cash value. The cash value grows at a guaranteed minimum rate written into the contract, so it can never go backward in a normal year. On top of the guarantee, if you buy from a mutual insurance company, you also receive dividends. A mutual company is owned by its policyholders, not by Wall Street shareholders. When the company does well, it pays a share of the profits back to the owners, which is you. These dividends are not guaranteed, but the strong mutual companies have paid one every year for over 100 years, through the Depression, through every crash. Those dividends buy more coverage and pour more money into your cash value, which compounds the growth over time. So a whole life policy has 3 numbers you watch. The death benefit, which is what your family receives when you pass. The cash value, which is the living money you can use while you are alive. And the premium, which is what you pay in. Now, here is the catch that kills most policies. In a normal whole life policy, the first few years of premium go heavily toward the agent's commission and the insurance costs. So if you put in $40,000 the first year, your cash value might only show $15,000. People see that, feel robbed, cancel in year 2, and lose money. That is the horror story you have heard, and it is real. The wealthy avoid that entirely by designing the policy differently. They tell the agent to make the base policy as small as the law allows, and to pour the rest of the premium into something called a paid-up additions rider. That rider has almost no commission, so the money goes almost straight into cash value. A well-designed policy can show 60, 70, even 80% of your first-year premium as usable cash value on day one instead of 15%. Same company, same product category, completely different machine because of how it is structured. The agent earns far less commission on the high cash value design, which is exactly why most agents never show it to you. Aunt Yvonne put it simply. She said the policy itself is neither good nor bad. It is a tool, and almost everyone who got burned was handed the wrong version of it by someone earning a check. Let me go deeper on the engine, because this is where the strategy lives or dies. The paid-up additions rider is the secret. Every dollar you put into it immediately buys a small chunk of fully paid-up insurance, and almost all of that dollar shows up as cash value you can use. The base policy is the slow, expensive part. The paid-up additions are the fast, efficient part. The wealthy minimize the base and maximize the additions. They call this overfunding the policy. Overfunding means you are deliberately stuffing as much money into the cash value side as the law will allow, while keeping the death benefit small enough that the IRS still treats it as life insurance. Why does the IRS care? Because life insurance gets enormous tax advantages, and if you could pour unlimited money in, everyone would use it as a tax shelter instead of as insurance. So Congress drew a line. It is called the MEC limit. MEC stands for Modified Endowment Contract. There is a test, the 7-pay test, that caps how much you can fund a policy in its early years relative to the death benefit. Stay under the line, and your policy keeps every tax advantage. Cross it, and the policy becomes a MEC, which means your loans and withdrawals get taxed like a retirement account. Gains first, with a penalty before age 59 and a half. The entire art of designing one of these policies is funding it right up to the MEC line and not $1 over. You want maximum money working for you with maximum tax protection. A good designer runs the software to find that exact number for your age and death benefit. Now, how does the money grow? 2 layers. The guaranteed layer is written in the contract, often around 2%. That is the floor. It cannot go below that. The dividend layer sits on top, and for strong mutual companies, the total credited rate has run in the neighborhood of 5 to 6% gross in recent years. Out of that, you are paying the internal insurance costs, so the net return on your cash value over a long horizon tends to land around 4 to 5%, tax-deferred. 4 to 5% does not sound exciting next to the stock market, but notice 3 things. It is tax-deferred, and as you will see, you can access it tax-free. It is guaranteed not to lose money in a down year, and it is uncorrelated to the market, which makes it behave like the safe, bond-like portion of your portfolio, except it does more than a bond ever could. Here is the timeline that matters. In a well-designed, overfunded policy, you are usually cash positive, meaning your cash value exceeds what you have paid in, somewhere between year 5 and year 7. Before that, you are slightly underwater because of the upfront costs. After that, the compounding takes over, and the gap widens in your favor every year for the rest of your life. By year 20 or 25, the cash value can be well above total premiums paid, and the death benefit has grown far beyond where it started. This is why everyone who treats it as a get-rich-quick move loses. It is a get-rich-slow machine. You are building a private pool of capital that grows steadily, never crashes, and that you can borrow against at will. The patience is the price of admission. Aunt Yvonne said the people who win with this are the ones who think in decades. The people who lose are the ones who wanted their money to do something exciting in year 2. Now we get to the part that makes the wealthy love this thing, the policy loan. Once you have real cash value built up, you can borrow against it. And the way the loan works is the entire reason this strategy exists. So listen closely because almost nobody explains it correctly. When you take a policy loan, you are not withdrawing your cash value. Your cash value does not leave the policy. Instead, the insurance company lends you their money out of their general account, and they use your cash value as the collateral. Think of it exactly like a home equity line. The bank lends against your house, but your house does not shrink. Your equity is the collateral, not the source. That distinction is everything. Because your cash value never leaves the policy, it keeps earning dividends and guaranteed interest on the full balance, as if you had never borrowed at all. You are spending money on one side and still earning on the same money on the other side. That is the two places at once effect from the opening. There are a few mechanics to know. The insurer charges interest on the loan, typically somewhere around 5 to 8%, depending on the company and the era. That sounds like a lot until you remember your cash value is still growing underneath it. If your cash value is crediting 5% and the loan charges 5%, the loan is nearly free in real terms. Some companies offer what people call a wash loan, where the credited rate and the loan rate are matched, so the net cost is close to zero. There is a nuance between two types of companies. Non-direct recognition companies pay you the same dividend whether or not you have a loan outstanding, so your borrowed money truly keeps earning full freight. Direct recognition companies adjust the dividend on the borrowed portion, sometimes up, sometimes down. Neither is automatically better, but for aggressive borrowing strategies, many people prefer non-direct recognition. Ask which one you are being shown. You set the repayment schedule. There is no loan officer, no credit check, no application, no approval. The money is yours by contract. You can pay it back next month, next year, or never. If you never pay it back, the outstanding balance plus accrued interest is simply subtracted from the death benefit when you pass. Your heirs get what is left, still income tax-free. And the loan itself is not taxable income. Borrowing is never a taxable event in the United States. When you take out a mortgage, you do not pay income tax on the loan. Same here. So as long as the policy stays in force and is not a mech, you can pull cash out of it for the rest of your life and never trigger a tax bill. That is the machine. Tax-free access, uninterrupted compounding, no lender, on your schedule. Let me make the two places at once idea concrete, because when it finally clicks, you understand why a billionaire would bother with a 4% asset. Picture two people who both need $30,000 for a car. Person one has $30,000 in a brokerage account earning 7%. She sells, pays capital gains tax on the growth, takes the cash, and buys the car. Her $30,000 is now gone from the market. It has stopped earning. Over the next 5 years, that $30,000 earns her nothing because it is sitting in a depreciating car. The car cost her the $30,000 plus all the growth that $30,000 would have earned. Economists call that the lost opportunity cost, and it is invisible, so people ignore it. But it is real money. Person two has a whole life policy with $60,000 of cash value. He borrows $30,000 against it and buys the same car. His $60,000 of cash value stays in the policy, in full, earning its 5% dividend on the entire $60,000, not on $30,000. He pays the insurer back over the next 3 years at his own pace, with interest. But here is what happened. His money financed the car and stayed invested at the same time. He recaptured the growth that person one threw away. That is the core move. The wealthy do not interrupt their compounding to buy things. They borrow against their compounding pool and let it keep running. Over a lifetime of cars, tuition payments, business expenses, and investment opportunities, recapturing that lost growth on every purchase adds up to a staggering number. There is a second layer, the truly strategic use. When you borrow from your policy to buy something that itself produces a return, you are stacking two returns on one pile of money. Say Aunt Yvonne's business owner client borrowed $100,000 from his policy to put a down payment on a rental property. That $100,000 was still earning 5% inside the policy. The rental it bought was earning him rent and appreciation on the outside. $1, 2 engines. He paid the policy loan back from the rental's cash flow, and when it was paid off, the capital was fully restored inside the policy, ready to be deployed again for the next deal. That is what the infinite banking people mean when they say velocity of money. You are not parking capital and watching it. You are running the same capital through purchase after purchase, recapturing the interest you would otherwise have paid to a bank, and never breaking the underlying compounding. Now, I want to be honest, because this is where the sales pitches get dishonest. It is not free money. You pay loan interest. The underlying growth is modest, and if you borrow recklessly and never repay, you can erode the policy. The magic is real, but it is not infinite, despite the name. What it genuinely does is let you be the lender and the borrower at the same time, keep the spread, and keep your money invested while you spend it. For someone who finances a lot of large purchases over a lifetime, that edge is worth real money. Aunt Yvonne said the client never used a regular bank for anything he could finance through his policy. The bank, he said, should be working for you, so why hand it the interest? So how do you actually run this, day to day? The concept has a name, infinite banking, popularized decades ago by a man named Nelson Nash, and the practice is simpler than the jargon makes it sound. You start by building the pool. For the first several years, you fund the policy hard, up to that MEC line, and you mostly leave it alone. You are not banking yet. You are building the bank. This is the patience phase, and it is where most people quit. Resist that. The pool needs to be big enough that borrowing against it actually replaces a real bank. Once the pool is meaningful, you flip into using it. Big purchases that you would normally finance through a lender or pay cash for out of savings, you now route through the policy. Car. Instead of a 5-year auto loan from the dealer, you borrow from the policy and pay yourself back on a similar schedule. Now the interest you would have paid the dealer stays in your ecosystem, and your cash value never stopped growing. A home renovation, a tax bill, a business inventory order, a real estate down payment, all of these become policy loans. The discipline is that you treat the loan like a real obligation. You pay it back. The system only works if you behave like a responsible bank to yourself. The people who borrow and never repay slowly hollow out the policy. The people who repay faithfully keep the machine humming for life. Business owners get the most out of this, which is why Aunt Yvonne's client, a contractor, loved it. His business had lumpy cash flow, big expenses, slow-paying customers. Instead of a bank line of credit with covenants and credit pulls and a banker who could cut him off in a downturn, he had his own policy. He borrowed for materials in spring, repaid when the jobs closed in fall, and the bank could never call his loan or change the terms because he was the bank. There is an estate angle too, and it is enormous. The death benefit, which has been quietly growing this whole time, passes to your heirs completely income tax free. So you spend the cash value during your life through loans, and your family still receives a large tax-free payout when you pass, minus any loan balance you left. You essentially get to use the money twice, once while alive through borrowing, and once at death through the benefit. This is why old money families have used these policies for generations. It is a multi-decade, even multi-generational capital system. Some families run what is called a family bank, where the policy lends to the next generation for their first home or their first business. The kids repay the family pool, and the capital recycles down the bloodline instead of out to a commercial bank. I want to be clear that you do not need to be wealthy to start. You need to be consistent and patient, and you need a foundation already in place. But the mechanism is the same whether the policy holds $50,000 or $5 million. Aunt Yvonne started a small one in her 60s, not for herself, but so there would be a tax-free pool her family could borrow from after she was gone. Let me pull the tax advantages into one clear picture, because the tax treatment is the real reason the wealthy choose this over a simple savings account. There are 3 tax-free layers, and they stack. Layer 1. The cash value grows tax-deferred. Every year your money compounds, and you own nothing on that growth, the same way a 401k grows untaxed while it sits. There is no annual tax drag, which over decades is a meaningful advantage over a taxable brokerage account, where you pay tax on dividends and gains along the way. Layer 2. You access the money tax-free through loans. This is the piece that beats a 401k. With a retirement account, you eventually pull the money out and pay ordinary income tax on it. With a properly structured policy, you borrow against the cash value instead of withdrawing it, and because a loan is not income, you pay 0 tax on the access. This is how high earners create a stream of tax-free cash in retirement that sits completely outside the IRS brackets. Some people use it specifically to avoid pushing themselves into a higher tax bracket or triggering taxes on their Social Security. Layer 3. The death benefit passes income tax-free to your heirs. Life insurance proceeds are not subject to federal income tax, so whatever is left when you pass, after any outstanding loans, goes to your family without an income tax bill. For families with estates large enough to face the federal estate tax, policies are often owned inside an irrevocable trust, so the death benefit also sits outside the taxable estate, which is a whole strategy of its own and absolutely requires an estate attorney. Stack those three and you see the structure: tax-deferred growth, tax-free access, tax-free transfer. There are very few places in the entire tax code where you get all three on the same dollars. A Roth gives you tax-free growth and access, but has tight contribution limits. A 401k gives you a deduction going in, but taxes everything coming out. A whole life policy has no contribution limit other than the MEC line relative to your death benefit, which means a high earner can move far more money through it than the retirement account caps allow. That last point is why this is a rich person tool more than a beginner tool. If you can only save $5,000 a year, put it in a Roth and index funds and be done. The retirement accounts are more efficient at small scale. But once you are maxing every tax-advantaged account available, and you still have surplus income looking for a tax-protected, liquid, guaranteed home, the policy becomes one of the few remaining doors. That is the income range where it earns its keep. One firm rule that protects all three layers: the policy must stay in force until you die. If you surrender it while you are alive with gains, you owe tax on those gains. The strategy assumes you hold it for life, borrow against it, and let the death benefit clean up the loan at the end. Break that assumption, and the tax math changes against you, which is the perfect setup for the 3 ways people get burned. I promised you the 3 ways people get burned, and I am keeping that promise, because the internet is full of people who lost money on whole life, and they were not lying. They just got caught in one of these 3 traps. Trap 1. Buying the wrong design. This is the most common by far. An agent sells a standard, commission-heavy whole life policy with no paid-up additions rider, or a tiny one. The client funds it, watches the cash value crawl for years because the costs ate the early premiums, gets frustrated, and quits. They did everything the agent said and still lost, because the policy was built to pay the agent, not to build cash value. The fix is non-negotiable. You demand a high cash value, overfunded design with a large paid-up additions rider and the smallest legal base policy. If the agent resists or cannot show it to you, walk away. Their commission is inversely related to your benefit, so a good designer is deliberately taking a pay cut to build you a better machine. Trap 2. Surrendering early. A whole life policy is a long game. The first several years, you are slightly underwater because of upfront costs. If life forces you to cancel in year 2 or 3, you lock in a real loss. This is why I said in the setup that this strategy sits on top of a finished foundation. You should never fund a policy with money you might need to pull out and surrender in a few years. If there is any real chance you cannot sustain the premium for at least a decade, this is not your tool yet. Build the emergency fund first so you are never forced to surrender at the worst time. Trap 3. The lapse with a loan tax bomb. This one is sneaky and it has wrecked people. Say you borrow heavily against the policy for years and stop paying premiums and stop paying loan interest. The loan keeps growing. Eventually, the loan plus interest exceeds the cash value and the policy lapses. It collapses. The instant it lapses, the IRS treats all those tax-free loans as if you withdrew the gains, and you get a tax bill on phantom income, money you spent years ago and no longer have. To avoid this, you monitor the policy, you do not overborrow, and you keep enough cash value cushion that the loan can never eat the whole thing. A good advisor sets up alerts. Discipline prevents it entirely. Notice the pattern in all 3. The product did not fail. The structure, the timing, or the discipline failed. Whole life punishes the impatient, the undercapitalized, and the careless, and it rewards the patient, the funded, and the disciplined. Annie Vaughn said that is true of most powerful financial tools. The tool is fine. It just has no mercy for shortcuts. Let me put real numbers on a real policy so you can see the whole arc. These are illustrative, rounded for clarity, and your actual numbers depend on your age, health, and the company. But this is the shape of it for a healthy person in their early 40s funding aggressively. The setup: $40,000 a year in premium, designed as a high cash value policy with a large paid-up additions rider, funded right up to the MEC line from a strong, non-direct recognition mutual company. Plan to fund it for 10 years, then let it run. Year 1. You have paid in $40,000. Because it is overfunded with a big additions rider, your cash value is around $28,000, roughly 70% of premium available on day 1. Compare that to the 15% a poorly designed policy would show. The death benefit starts somewhere around $700,000 because the small base plus the additions buys a large benefit. Year 5. You have paid in $200,000 total. Your cash value is around $190,000 to $200,000. You are right around break even, which is normal and expected. This is the bottom of the patient's valley. Most quitters quit right here, 1 year before it turns. Year 10. You have paid in $400,000 total, and you stop funding. Your cash value is now around $460,000, comfortably above what you put in, and it is compounding on the full balance every year. Your death benefit has grown past $1 million. Now the bank is built. This is where you start using it. Say in year 10, you want to buy a $100,000 piece of a rental deal. You borrow $100,000 against the policy at, say, 5%. Your full $460,000 of cash value stays in the policy and keeps earning its roughly 5% dividend. The rental throws off cash flow, and you use that cash flow to repay the policy loan over 5 years. When it is repaid, your $460,000 never skipped a beat. It kept growing the entire time, and you now also own a piece of a rental that grew on its own. 1 pile of money, 2 returns. Year 20. You stopped paying premiums a decade ago, yet because dividends keep compounding on the whole balance, your cash value has grown to roughly $750,000 to $800,000, and your death benefit is well over $1.25 million. You never added another dollar after year 10. The machine ran on its own. Now run the lifetime pattern. From year 10 onward, you borrow for cars, you borrow for opportunities, you repay yourself, and the cash value keeps climbing because the loans never actually remove it. In retirement, you borrow a tax-free income stream against it instead of withdrawing taxable money from your 401k, which keeps your taxable income low. And whatever balance remains at death pays out to your family income tax-free, minus any outstanding loan. Is the internal return spectacular? No. On the cash value alone, it is around 4 to 5%, less than the market. But look at what you actually got: a guaranteed, never crashing, tax-advantaged pool that you could spend and keep at the same time, that gave you tax-free retirement income, and that left a tax-free inheritance. That bundle is why the wealthy run this alongside their stocks, not instead of them. It is the safe money, do everything layer of the plan. So here is the whole machine in one breath. You buy a properly designed, overfunded whole life policy from a strong mutual company. You fund it up to the MEC line for several years to build the pool. The cash value compounds tax-deferred and never goes backward. You borrow against it tax-free, while the full balance keeps earning, so your money works in 2 places at once. You repay yourself like a disciplined bank. And at the end, the death benefit passes to your family income tax-free. Tax-deferred growth, tax-free access, tax-free transfer, all on one pile of capital. It is not magic, and it is not for everyone. If you are still carrying high-interest debt, or you have not built your foundation, this is not your move yet, and anyone telling you otherwise is selling. But if you are a high earner who has maxed the easy accounts, and you want a guaranteed, liquid, tax-advantaged layer you can borrow against for life, this is one of the last great doors in the tax code, and now you know how to walk through it without getting burned. This week, 2 things. First, If you are considering this, find a fee-conscious advisor and ask for a high cash value, overfunded illustration, and compare it to the standard one they would normally sell. The difference will shock you. Second, before any of that, make sure your foundation is finished, because this sits on top. In the next video, Aunt Yvonne is going to break down the account the wealthy quietly treat as a stealth retirement fund, the health savings account, and the way they use it that has nothing to do with medical bills. Subscribe so you do not miss it. And tell me in the comments, were you ever pitched a whole life policy, and now do you think it was the good design or the bad one? I will see you in the next one.